Hi everybody. This chapter we're going to be dealing with profit margin, investment turnover, and rate of return, and residual value, transfer pricing, and doing a divisional income statement. So what I want to start out with is doing the profit margin, investment turnover, rate of return, and residual value. Or residual income, I'm sorry. So I've given you some information. We have income from operations is $58,000. We have invested assets of $725,000. We have sales of $884,000, and we want a minimum acceptable rate of return on our assets at 6.50%. Okay, so this information will be given to us. So let's start off. First, let's find our profit margin. Your profit margin is the difference between your income from operations, and you divide that by sales. So that gives us 6.6%. As you're doing your homework, make sure you see on the note on the problem whether they want 1 decimal, 2, or 3. I'm just taking this out 1 decimal point. Now your investment turnover. This is looking at the difference between your sales and your invested assets. So dividing those out. So you have 1.22 turnover on your investments. Now the rate of return, we have to know what our profit margin ratio, and we have to know what our investment turnover is. So we're going to divide the 6.6% divided by the 1.22. I would flip that. I apologize. Let's take the 1.22. Let's divide it by the 6 points. Oh, what am I? Okay, sorry about that. For the rate of return, we need to multiply our profit margin by our investment turnover. So the rate of return on our investments is 8%. Now let's look at residual income using the same information. They want our income from operations, that is the $58,000. Now we asked for less our minimum acceptable income from operations as a percent of assets. Well, we're telling them that we want a minimum acceptable rate of 6.50. So what we do is we take our investment assets and we take it times 6.50%. So then that gives us, if we subtract the two, that gives us a residual income of $10,875. And you'll find more of this in your reading, but this is just the process of how to do your profit margin, investment turnover, and rate of return and residual income. Now I want to go to another one. I want to go into transfer pricing. So transfer pricing is where we have the option. Some companies will buy material outside of their plant. They don't make the material. So they buy it from outside resource. I know like John Deere, they have a certain component that they get from another vendor. It's cheaper for them. Okay? And I had the situation where Wolf Division of African Company are currently purchased material used by the Wolf Division of African Company are currently purchased from an outside supplier at $75 per unit. The same material can be produced by the Lion Division of African Company, hope you like my names, at a variable cost of $57 per unit. The division is currently producing 185 units and has a capacity of 225 units. I want to pause there for a second. They have the capacity to do 225 units. They're only doing 185,000. This allows the Lion Company to be able to do this. If they were at 225 units and the capacity was 225 units, then we probably would not consider producing these for them. Okay? The Wolf and Lion Division have recently negotiated a transfer price of $67 per unit for 35,000 units. By how much will each division's income increase as a result of the transfer? So we're going to look at the increase in the Lions division, the supplying, and simply what we do is we look at the transfer price, the $67, minus the variable price, which was the $57, and we take it times the number of units. So I'm going to just literally spell that out here. We take the $67, the transfer price that they agreed upon, minus their variable cost per unit is 57, and we take that times the number of units that we would produce. Okay, so that's going to be your equation. So if we want to look at this, let's go ahead and do it where we have $67 minus the $57 times 35,000 units. Okay, I'm going to put that, I'm a picky person, I'm going to put that in my, we'll just do it in dollars. Okay, so the divisional's income from operations is $350,000. Now, let's look at, for the Wolf division, we're going to see what happens for them. And they're going to take that market price of $75 that they can purchase it for, minus that variable cost that Lion is offering, times again the units transferred. Okay, so we're going to take that $75 minus the $67 transfer price that they negotiated, times the 35,000 units. Okay, so that would be our equation. So we're going to use the $75. We're going to use the negotiated transfer price. Okay, let me change that to minus the, I like transfer price better. That way it really shows that we need to look at, this is what we can buy it for, this is the amount that we negotiated for, and this is the number of units that we're allowing, that we need them to produce. So if we do this, if we take our $75 minus our $67 times our 35,000 units, we're going to get a divisional income from operations $280,000. Now you need to decide, and this is where the managers come into place, they really need to decide, is this worth it, or do we continue to just have do we purchase the material from the outside supplier? And I said, it's a good, it could be a good thing, it could be a bad thing for Lion division. Their divisional income from operations is going to be $350,000. We're only going to be $280,000. So again, it's just a guessing game. It's one of those things that you'll talk to, your managers will talk to. Here, you could be getting more into quality control because you know it's coming from the Lion division. So you guys are kind of related. Getting it from an outside manufacturer, you always could possibly run into defects. You don't have that quality control. So I'm going to do another video on divisional income statement. I really don't think I can get that done in this amount of time, and it's about 9 minutes long already. Talk to you soon.